Have you ever actually stopped to wonder why the numbers on a screen or, the pieces of paper in your wallet mean anything at all? Well, welcome to This Explainer. Today we're diving right in and breaking down the hidden gears of global finance. We really want to understand why money only works when it represents real, tangible value. We're going to pull back the curtain on how economies actually function, how wealth is truly created, and why the financial systems running our daily lives are just so incredibly complex.
Okay, so here's our agenda for today. First up, we'll look at what gives money value. Then we'll dive into the bread analogy. Third, we'll cover debt, deflation, and digital gold. Fourth, we'll look at why everything costs more right now. And finally, we'll wrap up with how wealth is hidden and multiplied.
All right, let's jump right into Section 1. What gives money value? The reality behind the paper.
You see, a dollar or a yen, it isn't valuable because of the fancy ink on the paper. Not at all. It has value because of the actual goods, the investments, and the solid economic reality standing behind it. Currency value reflects reality, not just some random numbers. It's essentially this massive global marketplace where currencies compete against each other based on things like economic performance, trade balances, and, honestly, investor confidence. The number printed on the bill, it means absolutely nothing on its own. What really matters is the strength of the economy backing it up.
It's a constant tug of war, really. Look, when a country produces real value, like they're growing, they're making goods, they're attracting outside investment, the demand for their currency rises, pushing its value higher. But picture the exact opposite. Imagine job losses, struggling industries, or a government just printing unbacked money out of nowhere. Trust plummets, right? And when that happens, the currency absolutely tanks. Less trust means a weaker currency. It is literally a daily vote of confidence by the entire world on one specific nation's economic engine.
Moving right along to Section 2, the bread analogy and the mechanics of inflation. So it's a question everyone asks, especially when we're constantly hearing about trillions in national debt, right? Why not just run the printing press and solve everyone's problems? If a government needs cash for, say, roads or hospitals, why can't they just create $1 trillion and fix it? Well, to understand why doing that is a recipe for absolute disaster, we need to look at a highly specific, simplified scenario. Let's break it down. Imagine a perfectly balanced little town. In this town, we have exactly 100 people and exactly 100 loaves of bread available to buy. Now, let's say each person has exactly $10 in their pocket and each loaf of bread costs exactly $10. In this baseline economy, supply matches demand perfectly. Every single person gets a loaf of bread and the money circulates properly. Everything is in total harmony.
But what happens if the government just decides to print an extra $1,000 and hands it out to everyone? Remember, there are still only 100 loaves of bread. The town didn't bake any more. So everyone rushes to the baker with their new cash. Well, the baker, who is no fool, realizes everyone suddenly has extra money and just raises the price to make sure the supply lasts. Boom! Prices jump to $20, then $30 for the exact same loaf. That extra money didn't make anyone richer. Actually, it just diluted the value of every single dollar they already had. More money chasing the exact same amount of goods simply forces prices to climb.
You see, money represents work, resources, and productivity. Just creating more paper bills doesn't magically create any of those actual tangible things. If an economy doesn't grow right alongside its money supply, you just end up destroying trust in the currency itself. And that harsh reality is captured perfectly in this idea. You can't print wealth. You can only print inflation.
That brings us to Section 3, debt, deflation, and digital gold. What actually happens when the whole system freezes?
Now, you might be thinking, falling prices sound like an absolute dream, right? I mean, your rent and groceries getting cheaper every single month? Sign me up. But economically speaking, it's absolute paralysis. While rising prices definitely hurt your wallet on a day-to-day basis, falling prices, or deflation, are actually a macroeconomic nightmare where the entire financial system just locks up entirely.
Think about it like this downward spiral. If you know a new car is going to be thousands of dollars cheaper in 6 months, you delay buying it, right? Why wouldn't you? Well, businesses notice those sales dropping, so they panic and cut prices even more. Then people wait even longer. As demand completely collapses over a few months, companies lose massive revenue, and eventually, they have to lay off workers. Unemployment shoots up, people have even less money, and on top of that, debt becomes completely crushing because loan payments stay the exact same size while your income shrinks. Everyone waits, nobody spends a dime, and commerce just grinds to a total, complete halt. So, as a totally different alternative to this painful inflation-deflation trap, look at Bitcoin. It basically uses math and built-in scarcity to function as digital gold. Because it operates on a decentralized public ledger, which we call a blockchain, there's no single bank or government institution that can just freeze an account or arbitrarily print more of it to pay off debts. There will only ever be exactly 21 million Bitcoins in existence. It is designed specifically to avoid that inflation trap we just talked about with the bread analogy, essentially trying to prove that you can create a working form of money entirely through math, rather than requiring blind trust in a government.
Okay, Section 4, Why Everything Costs More. Let's take a closer look at tariffs and housing.
All right, here is the harsh, honest truth about tariffs. Foreign countries do not pay them. Nope, the cost just quietly appears right there in your shopping cart. When a 25% tariff is placed on, let's say, foreign steel, the foreign country doesn't write a check to the government. Instead, the domestic importing company pays that tax right at the border. And to survive, that company just absorbs the cost by raising prices on everything made with that steel. Cars, washing machines, buildings, you name it. And it gets worse, because even local producers keep their prices high since they suddenly don't have to compete as hard. At the end of the day, tariffs are really just taxes on imports that get passed directly down the chain to you, the end user.
And then there's the housing market, which has just suffered this massive chasm over the last 50 years. Think about this. 50 years ago, an inflation-adjusted average home cost around $170,000. And a single-income family could actually buy it, to use as shelter. Today, that same average home is well over $400,000. Why the massive jump? Because homes fundamentally shifted from being just a place to live to being portfolio assets for Wall Street investors. When you, a regular buyer, are suddenly competing against a massive corporation for a neighborhood home, well, regular folks just get completely priced out.
Which leads us nicely into Section 5, Hiding and Multiplying Wealth. Let's talk about the games of the rich.
Look, whether you're actively involved in the stock market or not, understanding the stark difference between a trader and an investor completely changes how you view wealth creation. Trading? That's a panicked sprint. You're constantly staring at charts, you're betting on momentum, and you're desperately seeking fast profits from market volatility. But investing? That's a patient marathon. It requires holding on to quality assets and letting the magic of compound interest do all the heavy lifting over time. The wealthiest players in the market? Yeah, they almost always play the long game.
And here's a totally wild contrast for you. While debt is a heavy burden for the middle class, the ultra-wealthy actively use it to multiply their fortunes, and they do it entirely tax-free. Here's how it works. If you have $10 million in stock and you sell it, the government takes a massive cut in capital gains taxes, right? But if you borrow against it, using that stock as collateral at the bank, you get the cash you need without actually selling a single share. And no sale means absolutely no taxes. As long as your investment portfolio grows faster than the low interest rate on your loan, you are literally making money just by borrowing. The system absolutely rewards those who already have wealth, letting them borrow their way to even more. Crazy, right?
Now, on the darker side of things, for illicit wealth, bad actors use these 3 very specific sequential steps to hide their crimes within the massive, complicated noise of global finance. First is placement. That's getting dirty physical cash into the financial system without triggering any bank alarms. Second is layering, basically moving that money through a web of shell companies and complex international wire transfers until the paper trail is totally buried. And finally, integration. This is funneling that now hidden money into a legitimate business like a restaurant or real estate, paying regular taxes on it, and making it look like totally clean, hard-earned profit. Always remember, money laundering doesn't actually hide the money, it hides the crime.
Well, as we wrap up this explainer, I want to leave you with a final thought to really chew on the next time you look at your bank account balance, or even just go to the store to buy a simple loaf of bread. We've seen exactly how money is tied to economic reality, how printing money just dilutes your purchasing power, and how the actual rules of finance shift dramatically depending on how much wealth you already hold. The whole system is just constantly moving, so you have to ask yourself, is your money out there representing real, tangible value, or is it just slowly diluting in the machine? Keep that in mind, keep learning, and I'll catch you in the next explainer.